Good evening, everyone, and thank you for joining in today for our coverage on PharmEasy. PharmEasy has been on, a lot of people's radar, and a lot of people have invested into it. A lot of people have invested into it at the wrong pricing, and we've gotten a lot of requests from a number of people asking us to, basically cover PharmEasy and to do a deep dive into how the investment is and how the company is doing. So today the agenda will be to cover the entire company or the entire operations of PharmEasy, what makes it such an attractive investment, why are so many people betting onto it, how does the overall online health space look like, right? So without further ado, let's get started. Right. If we see a macroeconomic picture on how the healthcare industry in India looks like, so let's first see some broad line headline figures in terms of what is the healthcare spending, which is or where does India rank in terms of healthcare spend as a percentage of GDP versus how it is for other nations. So as a percentage of our GDP, which is close to say a $2.7 trillion economy right now, India spends 4.4% of its GDP on healthcare, while opposed to a country or a developed country like US, which spends almost 17.7% of its GDP on healthcare. The world average for healthcare spending is 9.86% of the GDP. Comparing to a similar sized country wherein the population base is very large, the GDP expenditure, the percentage GDP expenditure on healthcare for China is 5.4. So what this graph essentially tells us is that percentage of GDP which is spent on healthcare is set to increase, and this is along with the natural increase in GDP, right? Because a lot of people in India right now have very little to no access to healthcare services. As these people increase in well-being, a larger portion of their wallet share will be spent on healthcare in India. Next, what we have on the right side of this graph is what kind of spend is done on pharma, diagnostics, OTC, and consultation services. In FY22, we spent a cumulative 4.2 lakh crores on pharma, diagnostics, and OTC services. The expectation by FY 2025 is that we will be spending close to, as a country, we'll be spending close to 7.5 lakh crore in on the pharma, diagnostics, and the OTC space. So basically, this graph tells us that India is at the very lower end of the spectrum when it comes to spending on healthcare, spending on pharma, spending on hospital supplies. And as Indian economy matures and as the overall well-being and the overall purchasing power of the people increases, healthcare will be an even larger part of their wallet share, and it'll grow stupendously in the next couple of years to come. Now let's break this number down into a little more specific figures into how this entire healthcare space in India looks like. So if we see in 10.4 trillion, 10.4 trillion is the overall size of the healthcare space in 2020. And out of this, the largest spending is on hospital treatments, which accounts for 5.5 trillion. So just for a little clarification here, 10 trillion is essentially 12 zeros after a number. So it is essentially lakh crore. So this is 10 lakh crore. This is overall treatment on hospitals is 5 lakh crores. Overall spend on the pharma pharmaceutical sales is close to 2 lakh crores, and diagnostic spend in India is close to 60,000 crores. These are extremely large figures. Consultation, which is basically your consultation with doctors, OPDs, healthcare service providers, is almost 70,000 crores. Hospital supplies alone accounts for 50,000 crores of spend in India, right? And this totals up to a 10 lakh crore figure for the overall spends in India. Now by 2025, this spend is supposed to or expected to grow from a $10.4 trillion INR market to a 20 trillion INR market. And this is as per the Red Sears research, which was published, I think, close to around 1.5 years back. And this gives us a growth rate of almost 14% annualized, with the majority of increase happening in the hospital supplies segment, in the OTC segment, and in the diagnostic segment. And this remains very important for our company of the day, which is PharmEasy, because it is very heavily dependent upon these 3 4 segments where the growth figures seem very very high. What is even more interesting is the online penetration figures which you see here. So online penetration into the pharma segment is only 2.3%. So if 100 rupees of pharma products are sold in India today, only 2.3 rupees is sold online. For diagnostics, that figure is even smaller. Out of the entire purchase or entire investments into the diagnostic segment, only 0.6% of the spend is done online. OTC still accounts for a large portion of 5.2%, and consultation is again a very, very, very small fragment of the overall diagnostic or consultation market, standing at 0.8%. What basically this slide is trying to bring through or is trying to bring out is essentially that the online penetration in the healthcare segment is very, very, very low in India. It is barely in the range of single digits, and in most cases, it is not even a single digit. It's in less than decimal points in India, which is why the expectation or there is the enthusiasm in the market for healthcare startups is very high. The expectation is that as India digitizes, as people grow more familiar with smartphones, as people start using apps to conduct their daily healthcare requirements, the exposure of apps like PharmEasy, Tata 1mg, and NetMeds will keep on increasing, and these online penetration levels will go 3x, 4x from here. So this growth of 14% in diagnostic services might be the overall growth for the entire diagnostic market, but the online diagnostic market is expected to grow much faster than this. That will probably grow at 100% growth rate. OTC pharma delivery online will grow at 100% growth rate. Even hospital supplies will grow much, much faster than what the overall market is growing at. And this disruption is what is getting private equity firms, venture capitals, and investors very interested into companies which are trying to solve the challenges in this particular space. Coming to PharmEasy now. So we did a basic understanding of how the healthcare segment is. We saw that yes, healthcare is supposed to boom, both in terms of gross numbers and also specifically in terms of online treatments, right? So the online market is supposed to grow much faster than the offline space, while the offline plus online market is supposed to grow at close to 15 to 21%. The pure play online services will be expected to grow at a pace of more than 85% for the next 3 to 4 years. Now, PharmEasy, like you know, is an end-to-end solution for all OTC drugs, diagnostics, hospitals, and any medicinal requirements. And how the PharmEasy ecosystem is built out is very interesting, right? So this is a take from the company's DRHP, which was filed earlier this year. So the first part of this is the pharma companies. So this is how the pharma supply chain goes. There is a pharma company, which is companies like Sun Pharma, Biocon, which essentially do drug development and then sell it downwards in the supply chain. So pharma companies generally produce the drugs, they then sell it to wholesalers, who then sell it to pharmacies, and the pharmacies are then taking these drugs to the final consumers. These pharmacies are tied up with both the app and the direct consumer as well. On the other side of the spectrum, on the other side wherein there are doctors and there are hospitals, there is majorly clinics and doctors, which is basically your OPDs and consultations, which the entire India does. And then there is the diagnostics labs, wherein these are majorly standalone chains, or these are large labs wherein you get your testings done. And then there are hospitals where essentially you do a mix of treatment plus diagnostics. What PharmEasy has essentially done is it has created some offering in every step of the way. So right from the wholesaler, it has tried to capture by introducing an app called Retailio, which is a online pharma platform app. For PharmEasy's, it has created a pharmacy ERP system, which it has branded under the under Redbook. The PharmEasy online marketplace actually serves as a meeting point for all of these moving parts combined. So this remains a marketplace for PharmEasy's, the pharmacies, the consumers, the doctors, and the diagnostic labs, all coming together in one app so that the entire needs of the entire supply chain and the end consumer can be serviced in the same spot. Most of these, for your information, are acquisitions by PharmEasy. PharmEasy essentially is headed under API Holdings, and API Holdings has majority stakes in most of these companies. Thyrocare is the company which they had bought out. It was a listed company earlier. They bought it out, and that provides the entire that handles the entire diagnostic side of it. Docon was acquired by PharmEasy to do EMR and e-consultation with doctors. AcnaMed is basically a company which helps hospitals do tech-enabled supply and procurement, right? So this AcnaMed will tie up with hospitals, and it will manage their entire requirements or entire purchase order for anything. And PharmEasy app, which essentially rests on your phone, is the one which connects all of these moving parts together and helps the entire PharmEasy, the diagnostic chain, the e-consultation, and the consumer to be on the same platform and for everything to fall together. So like we were discussing earlier, what PharmEasy has created is it has created a value proposition for all stakeholders, right? From pharmacies. For pharmacies, it has given you a comprehensive offering. It has given them competitive prices, technology, and access to credit. For wholesalers, they have given them access to the pharmacy network, fulfillment and last mile delivery, and digital payments and collections, which helps wholesalers digitize their entire business. For pharma companies, they help with reliable and efficient supply chain management, they help with market intelligence, and they do channel engagement partner. For consumers, obviously, it becomes a one-stop shop where they can get all of their healthcare needs met. They can get their prescription drugs, they can get their teleconsultations done, and they can get their diagnostic tests done with affordability, convenience, and authenticity. For doctors, it is helping them run their practice a little more efficiently, and they are improving the entire service and the experience. Just some housekeeping rules. In case there are any questions, we would request you to type them out on the chat box. If it is pertinent at that point of time, we will take it parallelly, or else we will just bunch up all of the questions and we'll take it at one shot at the end of the presentation. Now, let's see how this journey of PharmEasy started. So PharmEasy was actually started as a company called Dial Health. So Dial Health started back in 2012, which was basically doing retail pharmacy and hospital supply chain management. This then moved into, and this was started by one of the co-founders of PharmEasy, and Ascent Healthcare was started by the other founder of PharmEasy. And Ascent was basically into the pharma distribution business through backward integrations across the supply chain. In 2017, they launched Retalio. In 2019, they launched Redbook, which is a ERP management for pharmacies. In 2016, they launched Docon, which helps with online consultation for doctors and teleconsultation. MedLife was one of the large acquisitions which was done in 2021. MedLife had a huge chain of both digital healthcare companies and offline network of stores. Thyrocare was the diagnostics piece in the PharmEasy puzzle, which allowed them to integrate diagnostic services into their product offering. AcnaMed, as we discussed, was again an acquisition by PharmEasy, which enabled them to become suppliers of choice for a large number of hospitals at one shot. And Marg ERP is again one of the largest ERP systems for pharmaceutical retailers. This was again done as an attempt to further get deeper and closer to the pharmacy network in India. So now let's see how all of this investment and how all of these things come together to make the PharmEasy ecosystem. So the PharmEasy app, essentially which rests on our phone, has become very large. So it has 25 million registered users and 2.4 million annual transacting users. It boasts more than 50,000 SKUs on its platform, and 64% of its GMV is from repeat users. Docon, like we discussed, is for teleconsultation. It has 4,600 doctors which are prescribing 34 lakh e-consultations. AcnaMed is servicing 926 hospitals. Retalio, which is basically for wholesalers and pharmacies, has 87,000 active pharmacies, which is almost 11% of the total pharmacy strength in India. and it has 3,200 active wholesalers on its platform. Thyrocare, like everyone knows, is one of the largest diagnostic chains in India. It has 17 labs, more than 4,500 diagnostic collection centers, and more than 880 phlebotomists on its payroll. Now that we have some idea on the operational side of things, let's see how the company has done financially. Right. So financially, FY20 is the first year for which we had the full results for API Holdings, because API Holdings was formed in 2019 itself. And that year they had done a revenue of 667 crores and a bottom line of negative 346 crores. In FY21, this figure quadrupled to 2,400 crores, with the profit falling from a 340 crore level to almost a 620 crore level. In FY22, the revenue again has more than doubled from 2,300 crores. It has gone up to 5,700 crores, which is more than a 150% jump in the top line. However, the bottom line has in fact gone up much higher than that. So from 620 crores, it has actually gone up till 4,000 crores of negative losses for FY22. And this is the reason, this is the single largest cause of concern for the company, that while it is growing in size, while it is able to double its revenue, while it is able to grow very fast, the growth in revenue is not able to keep up with generating the bottom line, and they are having to fund all of this growth with a lot of sales and marketing expenses. So moving to the next slide and understanding how PharmEasy has made its revenue. So essentially, if we see the majority split of revenue for PharmEasy comes from two segments. One is sale of products to retailers, and the other is sale of goods to chemists or institutions. Sale of services still forms a very small portion of its entire revenue base, and this is obviously other operating revenue. So majority of the revenue or the top line for PharmEasy is created by sale of products, which is accounting for more than 92% of the overall top line. Now that we have an understanding of this segment, the space of healthcare, now that we have an understanding of how the company formed, what is the pharmacy ecosystem, what are the apps which are available, what is the kind of financial numbers which it has done in the past, let us see what are the risks to the business. While the business is excellent, while there is definitely a need of the hour for digital health services to be blossom in India, there are a number of problems which it also faces. One is change in regulations. So the Indian Drug Pharmacy Act, which basically guidelines and controls who can supply drugs in India, who can and how to prescribe them and how to sell them, is a very archaic law. It is not meant for, or it was not foreseen at a time when digital healthcare was even an option. So it is meant for, or it is suited only to offline distribution of medicines right now. And therefore, until this change in regulation happens and it makes it more easy for online digital healthcare providers and healthcare medical providers to flourish, it poses a very significant risk to the business. Intense competition. So the competition has gone very intense in the last 2 years. Earlier it was not that high till 2020. PharmEasy had a very free run. It was able to dominate a large portion of the market without too much influence from other competitors. But in the last 2 years, Tata 1mg, NetMeds backed by Reliance, Sasta Sundar backed by Flipkart and Amazon all have entered into the pharmacy or the e-pharma space. And all of these are backed by very solid bank balances. They are backed by very solid investors who do not have any trouble investing a lot of money for a long period of time. So the problem with this competition is that for a long period of time, we expect that this market will require a lot of investments from the players, and it will not be a very easy battle to attain a majority share and to hold that majority share for very long. Third is compliance requirement. This is again covered when similar to the regulations. So, pharmacy and e-pharma delivery are again subject to a lot of compliances requirements, which are a little low when you are defragmented, but when you are as large as pharmacy or Tata 1mg, there are a lot of additional requirements which come into the play for you. Next, the next risk to the business which we feel is fraudulent activity and counterfeit products. So pharmacy or drugs are a very high value, low volume product. What essentially this means is that there is a very large chance of people producing counterfeit products to try and make a quick buck, and this impacts the entire supply chain or the entire pharma distribution chain. And this again presents a risks towards pharmacy's business, wherein it might be subject to fraudulent activities and counterfeit products. Last but not the least, what we see is that API Holdings was formed in 2019 and PharmEasy as a marketplace was launched in 2015. Therefore, there is not a very elongated history available wherein we could evaluate the company very, very thoroughly. Therefore, we only have the last 2 to 3 year data to evaluate the company and to come to a judgment on whether it makes a sensible investment or not. So this again is forms one of the uh, questionable changes or questionable items which investors should be a little careful about. Now let's come to some pure comparisons. Let's understand. We were just speaking about how the competition has heated up. So let's understand firstly how the e-pharma GMV is split. Now this particular slide is from a Bernstein research report, which was published I think close to early 2021. So it's almost 1.5 years old. Since then, 1mg, Tata 1mg has gotten much more aggressive, and therefore they might have acquired a larger slice of the pie. But when this data was published, 50% of the market share was held by PharmEasy, 15% was with NetMeds, 16% was with 1mg, and all of the other players contributed to 19% of the e-pharma GMV share. So what this basically tells us, at least the last available data point for the market share, PharmEasy had a outstanding and overwhelming majority in the e-pharma delivery space or the e-pharma GMB space. And if it would have been able to keep up with the growth and keep up with its market share, it will make things a little easier for PharmEasy because they have a very strong base to get started on. In terms of the other figures, we will get back to this. I will take you to the platform wherein we will discuss this entire peer comparison piece. Last but not the least, what we have tried and covered is also the valuation at which PharmEasy has been trading. So before we come to this, I think let's shift gears a little and let's see uh, how the PharmEasy share price has moved, and then let's discuss a little on the valuation of it. So let me just show. Yeah. Great. Yes. So I hope all of you can see the uh, Altius platform, which I would have shared my screen as. And let's go to API Holdings and let's see how PharmEasy's share price has moved in the recent history. So if we see, PharmEasy first came into the pre-IPO space at a very high valuation, and this was a point when we were very conservative and we were very against investing into API Holdings or PharmEasy. But 2021 was a very different year. The startup craze was at its absolute peak. People were investing into any companies, any startup company which they could have gotten their hands on. And like it is visible on the graph, PharmEasy got introduced at close to 110 rupee level, and it went up to a peak of 135 rupees on 17th of November 2021. And after that, it has been a very sad, steady decline in its share price, with 128 on 20th November, then 100 in January 2022, then 90 in February 2021. Then it had a jump again back to 80 on February 20. Then March it came down to 68. April it came down to 63. May, June it came down to 48. June, July it came down to 40. August it came down to 35, and since then it has been stable between 34 and 36 for the last 3 months. So firstly, let's understand why has been there such a massive fall in the pricing, and what could have investors done so that they were not subject to this entire uh, challenge in wherein they lost a lot of money because of investing on the wrong price, right? And for that, I will bring you now to the valuation aspect of it. So if we see the empirical data which is available on the last fundraise, they raised close to $350 million in October 2021, which is barely a year back. And this was raised at a valuation of $5.6 billion, right? When you divide this roughly $5.6 billion at the current dollar to INR conversion rate and then divided with the number of shares outstanding, you will see that this comes to a rough price per share valuation of 60 to 65 rupees per share. And therefore, at any point of time, if you are investing at anything which is at more than 10 to 20% above the private market valuation, you are entering at a pricing which is very aggressive, and it will leave very little room for you to make an error, right? So if everything would have gone well, PharmEasy's IPO would have come out at that point of time, maybe everyone would have made money, right? But when you are investing, there has to be a margin of safety which has to be also available as a part of your investing price, right? So at a pricing of more than 65, we have always told investors that we are not very comfortable getting in at more than 10 to 15% of its pre-IPO valuation or of its private fundraise valuation. So 70 rupees was the peak at which we would have wanted to invest, and above 70 all pricing was absolutely incorrect and people should have refrained from investing into it. But now let's understand why the price has still fallen post 65. Now post 65, what has happened is the funding winter, so to say, came in, right? And funding winter is nothing but a time when, because of turbulent macroeconomic situations in India and across the globe, the venture capital space has slightly dried up. VCs, which were earlier very enthusiastic to give out crores and crores and thousands of crores of rupees to all kinds of startups, money making or not, have now become very selective in investing behind startups and have become very careful into what startups they will invest into, right? And this has essentially impacted the fundraising ability for PharmEasy also. Essentially, they were not able to raise money in the IPO because of certain regulatory challenges, and they were not able to raise money in the pre-IPO rounds as well because the VCs were not very comfortable with its valuation. So, what is the next planned fundraise for PharmEasy? The next planned fundraise is expected to happen within the next 2 to 3 months. They are expected to raise anywhere from 200 to 300 million dollars in this planned fundraise, and this is expected to happen at up to a 40% discount to its previous round. So at $5.6 billion, while the price per share was around 65, at a 40% discount to the previous round, the expected valuation will come close to around a $3 billion figure. And this will translate to a per share figure of 35 to 40 rupees, right? So how do we evaluate the company now, right? So even after the entire discounted fundraise, if they are even successful in doing the fundraise now, they will be raising capital at around 30 to 40 rupees per share pricing. And therefore, the current market price of PharmEasy in the pre-IPO space has also tumbled down to a very similar level at which the next pre-IPO or the next series fundraise for the company has been planned. So let me again shift back to this that I can take you through a couple of more things. Yes. So like I said, like we were trying to cover the valuation, 65 was 60 to 65 was what the average investment value for PharmEasy had been for its pre-IPO rounds, and therefore any pricing above this range the 68 or the 64 rupee range was in any case very, very high for an investor. And right now, the valuation which is ongoing for PharmEasy at 35 rupees is very close to what the next private fundraise is at. So a lot of investors generally ask us, what does this mean? Is this the right price to get in? Uh, or do you expect it to fall even more going forward, right? See, there is no right answer to this question. Obviously, we can't predict how the pricing will turn out. We can only ascertain at what pricing the market is bringing it up at. So currently, PharmEasy's next fundraise is planned at a valuation which is very similar to what it is right now, and therefore we expect that this is not a very critical zone for an investor to invest into. But what has to be kept in mind is the last year's financial figures, which have, although the top line has doubled, more than doubled, it has gone from 2300 to 5700 crores in just 1 year's time. But the bottom line has taken an even larger impact, where the losses have gone from 600 crores to almost negative 3500 crores. So investors who are not very uh, who are risk averse, or who are not very high risk, high return kind of an investor, should stay away from a PharmEasy, because that might be a stock which can again go down for the next 10, 15, 20%. We don't know. And it might be a while before the IPO also comes out. If you are an investor wherein you are looking at a slightly higher return and you are ready to take a slightly higher risk to get that return, yes, PharmEasy might be a good option for your portfolio, because we are very bullish on this space, right? So what the problem which PharmEasy is trying to solve is a very real problem, and there is a very real requirement for someone who to solve that problem. Now, how long does it take to solve that problem and to reach profitability, and will the market allow them that leeway, is something which is left up to the investors. But from the understanding on the street, from the feedback from other market participants and bankers, the expectation is that the pricing is expected to move back to the original fundraise value of $5.4 billion within the next 1 to 2 years, and that is when the company will come out with an IPO. Right? I think that is pretty much what we wanted to cover before we moved on to the Q&A section. I think I'm getting some messages to cover the IPO bit also. So in terms of IPO, basically the company had filed for a DRHP last year. They had gotten an approval on the DRHP, but then basically what happened was there are multiple regulatory challenges, as we discussed earlier, in terms of offline pharmacies and online delivery of medicines, and the entire uncertainty in the global startup ecosystem, because of which PharmEasy has actually withdrawn its IPO. Now, withdrawing an IPO is a very large event, right? The expectation is that the IPO for PharmEasy will not come at least for the next 1 to 2 years. So we only expect the IPO to come somewhere after 2024, and hopefully the street estimates is that by that time the valuation would again come back to the normalized valuation of I think $5.4 billion, and therefore if investors are looking at a long-term horizon for investing, they can maybe evaluate PharmEasy. I will now move on to the Q&A bit of it and take some questions which have been populated on the chat box. I think the first question is, in the last few years, there have been instances where offline pharmacies have challenged the legality of online pharmacy apps. Do we have any clarity on this? Yeah. So to answer that question, yes, this is one of the largest challenges, and this is what we had covered as a part of the presentation also. There is a huge challenge for online pharmacy deliveries to actually operate in India, because it requires a doctor's prescription, it requires a presence of a certified pharmacist at the point of delivery. But most of these startups have been able to find a midway to sort of work around this requirement, and they have developed their processes and systems which allows them to now service by complying with all of the regulatory requirements as well. Right? So we don't think that online delivery or online pharmacies should be too much of a challenge going forward. The next question is any tentative date when they'll apply for their DRHP again. So again, this is what we covered just. So there is possibly a 2-year delay which we expect before they refile for their IPO. So we do not expect the IPO to come before 2024. The next question is what's the right price as on today to invest in the company looking at FY22 financials for existing investors. So Mr. Porwal, essentially, like we said, this is a high risk, high return investment for sure. This is not a very safe bet that you can invest and you can forget and it will not go down in value, because the kind of losses which the company has to incur to grow their top line is very, very high, right? So therefore, they might have to keep on pumping in money before they actually be able to see the light of the day. So what I will suggest is that people who are investing uh, should sort of keep a track on the pricing. The current pricing of 35 rupees is not very high. It is in line with the next private round which is expected. So you can, if you are looking to build a portfolio in PharmEasy, you should start small and keep building as the price moves a little up or a little low, so that you don't invest a larger chunk of your investment at a certain price. But the pricing at this point in terms of comparison with the private markets is parallel, and therefore it is not expected to fall too much away from here. The next question is the last year top line would have had the impact of consolidating with Thyrocare. I still wonder what explains such a huge downward swing in net profits. Yeah, absolutely. So what I analyzed when we were going through the annual reports is that the major item which costed a lot of money to the bank, or what the large line items in terms of the expense items, was basically on the sales and marketing expenses. So because they are trying to grow very aggressively, they are investing very heavily on developing their supply chains, improving their delivery timelines, covering new pin codes, adding new products, and spending a lot on advertisements and marketing. So they took on Amir Khan as their brand ambassador, and then they ran an entire portfolio of ads, and that has costed a lot of money, which is a major part of their expense item. The next question we have is please provide view on management. So the management essentially run by Dharmil Sheth, Siddharth Shah is fairly stable, and there have been good reviews about the management overall. But what gives me comfort in terms of the management is that there is a lot of private equity investors on board, right? And the good part about having private equity investors on board is that the corporate governance is not sort of away, and what these investors ensure is that irrespective of who's leading the charge or who's the CEO, most of these companies are very well run. But in very high growth startups, you cannot have a very, very good idea on the management in any case. The next question, which is on the docket, is continuing my above question, should the existing shareholder average his or her investment? So, like I said, if you are a high risk, high return investor and you're looking to get exposure to the startup space, then only you should invest into it, because the funding winter is expected to last a little longer. You would have seen that the Fed has increased the rates again. There is expected to be a substantial turmoil in the financial markets for some time. Therefore, you should try and average out a little, but in smaller chunks, so that if there is a further downfall, basically, go for a dollar cost averaging, if you understand what I mean. Just a second. Yeah. Next question is based on one of the news articles. Their next year revenue should be around 1 billion, and losses per month is at 5 million now. How should we value PharmEasy considering this data? Okay, so let's look at the valuations, right? I think we've already discussed all of the numbers. So the top line for PharmEasy for last year was 5,000 crores. The current market cap at 34 rupees will come close to 20,000 crores. So you are giving a 4x multiple on top line, and the bottom line in any case is a very large negative figure, so there is no point comparing that to it. So in a sense, uh, if you compare this with the earlier round, wherein the top line was close to a 2,000 crore figure, and the valuation of the company was at a 30,000 crore figure, the multiple on the top line has come down from a 10x to a 3x 4x kind of a level, which is generally considered to be a logical valuation. But in this also, what will have to be analyzed is how much of the top line is also from trading between, say, a pharma company and say a wholesaler, or between a wholesaler and a pharmacy, because these will be very low margin items. So, to answer your question, Gajanan, how should we value PharmEasy considering this data? Ideally, a little lower valuation, something around a 30 rupees, should be a safer level to enter. Hitenge asks, is it likely to be taken over by another company? Uh, See, I don't think so, because PharmEasy has become too large, right? And uh, at this valuation, at this pricing, unless they are not able to raise a private round, I don't think that they will opt for an acquisition. But if they are not able to raise a private round, they might be acquired by, for that matter, Adani might acquire anyone in India right now. So that might be one acquisition or one area where Adani has not ventured out. But it's a very large investment. To answer your question, it will be a little difficult to acquire PharmEasy for another company entirely. And the only scenario where I see that happening is if they are not able to raise more capital in the private space. Got it. Great. I think that is it. A couple of other questions. What do existing investors do? So I think I've already covered this. For existing investors, I think if you continue to believe that the e-pharmacy space is a good space to invest into, and therefore there is uh, an opportunity for growth, you can average out your investment so that you have still lowered your average entry price. Uh, yeah, and that's pretty much we can do right now. Mm, yeah. Great. I think that pretty much covered it. Please make a balanced analysis on Ixigo as well. Okay. Thanks, Akshat. We will definitely try and cover Ixigo in our upcoming sessions. Thank you for joining in. Thank you, everyone, for joining in. It has been a pleasure covering PharmEasy today with you. We will share the link for people who've not been able to join, and keep following the channel so that you get updates on whenever we come out with a new uh, research report. Right. Take care, everyone. Have a good day. Thank you.